Today, I'm going to be sharing with you a recent client story of someone who's 57 years old with $5 million in retirement savings and needed to figure out how much they could exactly spend to retire right now. Now, I see this all the time. These are clients who have done everything right. They've had smashing success in the stock market and throughout their careers, but now as they get closer to retirement, they're terrified of making a mistake, right? It's spend too much and we end up back at work and needing to unretire, but spend too little and we risk wasting the healthiest, best years of retirement being way too cautious. So there's a balance. That's why I developed a specific method to determine that optimal spending level without having any regret or even having to sacrifice on lifestyle enjoyment. So that's why I'm making this video today, to show you exactly how you can safely spend $5 million in your 50s to ensure your money lasts throughout your lifetime, regardless of what gets thrown at you in retirement with regard to market environment. So without further ado, let's dive right on into it. Now, let me introduce you to Michael. Again, his name's been changed, but late 50s, $5 million accumulated across his 401k, company stock, rollover IRA, Roth IRA, and a brokerage account where he's done very well investing in single tech stocks. Now, all that aside, as retirement approaches, he's finding himself burnt out and just wanting to retire. And he's facing these key critical issues. And he's struggling with some other things as well, which is figuring out how much can he safely spend in any market circumstance and make that money last for 30, 35 years. He's got some behavioral financial issues as well, figuring out, I really don't want to let go of these stocks. They've been good to me. What happens if I sell them and they end up continuing to go up and up and up? And then from the technical side, he finds himself trapped with this dilemma of, I'm 57. I can't access my IRA or 401k without incurring any early withdrawal penalties. So where do I take my first dollar out without getting crushed in taxes? And then he's also fearful, frankly, and I see this a lot of times, of what happens, just my luck, if I retire and the market goes down by 20%, how does that impact? Should I have just stayed parked at work? And so you'll see some things here on his eMoney profile that we'll dive into how he's currently invested. He's a very growth-focused investor, and we'll get to that in a moment of how do we shift Michael's portfolio as he begins to transition into retirement. But when he first started working with us, he felt trapped of not being able to figure out how to translate his $5 million into a concrete spending plan. It just wasn't computing. And so when we first met, his plan, very dejected, was just to do what many continue to do, which is that they just keep working because it's easier to put off retirement for just another year, to not think about it, rather than to lean into the uncomfortability and figure out how to have a plan that's adaptable and adjustable regardless of what the market and life throws your way. So that's what we're going to lean into in this video, is to walk through the step-by-steps of how we built that plan, the obstacles we had to overcome, and ultimately what we were able to build for Michael. A few other hurdles Michael's facing going into retirement that I think we need to address up front. We'll list them out here, and then we'll dive into how we solved and built the plan for Michael. The first one is healthcare in early retirement. He has 8 years left until he qualifies for Medicare at 65. And that's going to be a separate line item that we're going to need to account and budget for, in addition to his just normal standard of living. So when we look at how much money needs to come out of his portfolio, we need to be sure to add whatever those health insurance premiums are. The second one, his living expenses. He's been making $300,000-$400,000 a year for the last decade plus, and he's gotten used to, comfortable with a certain standard of living, and he wants to maintain that in retirement. So we have to have a plan that's flexible enough that affords him that income without having to go backwards, and understanding how that adjusts in good and in bad markets. And then the last one is, you'll notice from his eMoney profile, most of his accounts are invested in the S&P 500 and single tech companies that he's done exceedingly well in. But as he's nearing retirement, he's finding he's playing a different game. It's less about accumulation and it's more about preservation and income. His needs are beginning to shift. And so we faced a big challenge of, how do we start to have that conversation to introduce not only diversification, but also how do we do it in such a tactical way without triggering too much in taxes? And so he's finding himself caught between that optimal portfolio allocation of where he should be to start drawing income and also tax efficiency. And so the big question that I challenged Michael with as he pushed back, hey, I can't do this. This is going to cost taxes, but what about this? Oh, it's just easier to stay at work. Michael, what game are you playing? Are we solving for retirement or how to build the biggest investment account balance possible? Because those are two very different games, two very different routes with very different strategies. Now, if you find yourself in a similar situation to Michael, where you're facing early retirement, you're ready to retire, you're not quite 59 and a half, and you have questions on how do I access my money before 59 and a half without triggering penalties? Or should I sell this single stock that's done exceedingly well, and how does it fit into my retirement plan? What I want you to do is click on the link in the description below, and I will send you a personalized Loom video analyzing your exact situation and showing you how you can optimize your retirement plan given your situation. This uncertainty was having a huge toll on Michael's life. You see, every day he had to go back into work was another day that felt wasted. And he was carrying this burden around that was so heavy despite having significant wealth. He was very conflicted, and all because he didn't have a retirement plan, an income plan. You see, he had a game plan on how to invest successfully, and he'd been doing that for decades, but now he had no exit plan. And so that each day he had to go back into work, he was wondering, am I wasting the best years of my retirement? And every month that passed was another month that he just said to himself, I'm never going to get that back. And so now that you've seen how heavy that this was for Michael, this next piece that we're about to explore is extremely important because I'm going to break down how we solved an income plan for Michael, how much he was able to successfully spend if he were to retire today, and how you can implement this exact same type of plan into your early retirement situation. The first thing we had to solve for Michael was how much can we afford to spend in early retirement? What is a sustainable withdrawal rate? And now research is going to tell us the longer our retirement, well, the less we want to spend initially. So we make sure we have more years to account for that we don't run out of money. In fact, as you'll see on this chart on the screen, RBC put out a study dating back almost 100 years looking at the various distribution or withdrawal rates and what the success rate subsequent was for that. And we see for a longer retirement, call it 30, 35, 40 years, it's going to be somewhere between 3 to 5%. Now, the second variable with Michael was that if a bear market occurs, how do we have a flexible, adjustable distribution strategy that adapts during those down years that gives our portfolio time to recover? In fact, I made an entire YouTube video on this that we'll link to in the show notes. And so as we went through on our financial planning software, we wanted to look at what is that maximum retirement spending that Michael can afford to spend in early retirement, triggering retirement at 57. And we'll also get into, well, where do we take our first dollar from? One big factor that was very important to Michael was he didn't want to compromise on his standard of living. See, he'd been accustomed to making $300,000-$400,000 a year for several decades, and he didn't want to compromise on that when he retired. And so we were able to put together an income plan that said, can your assets support that style of living? And one thing I challenged him with was, what are you willing to give up should markets decline by 15, 20, 25%? How much could you adjust and remove from your budget? Keyword here being temporary, right? Until markets recover. Because one of the biggest things we want to make sure of in retirement is giving our portfolio breathing room to recover rather than selling more to meet our living expenses while the market's down. And so what we were looking at for Michael was he said, you know what, something comfortable for me is about $15,000 to $20,000 of discretionary income. If I have that, I can do anything I want. I want that to include my insurance premiums, my taxes, and also any travel I want to do. 15 to 20,000. That's great. Things get tighter. I can cut below $15,000. So we said, perfect. Let's take a look at how much, based off your current assets, that your plan allows for you to spend. And we see we're right in this ballpark here, $200,000 to $230,000 a year, which translates, give or take, to about $15,000 to $19,000 of income, accounting for taxes, growth, and inflation. And as we know, there's a study, and I'll link to it here. We'll also put it on the screen. With Michael, we wanted to make sure that that amount translated to a safe distribution rate, where we said we want to make sure that we keep our distribution rate somewhere between 3 to 5%. Because again, the longer our retirement's going to be, the longer we want to make sure our money's going to last for, and vice versa. If you find this video and you're retiring in your 70s, you could have a higher distribution rate. Now for Michael, his plan had a caveat here, which was, I usually don't recommend someone take Social Security early unless health or other life circumstances dictate that. But in Michael's case, we said, hey, let's wait and see where the market and your portfolio is going to be by the time you hit 62. You're 57 right now. And so what we could see is your distribution rate, it's a little high, but it's doable. Should we take Social Security early at 62, you're okay. You see, that cash injection, the cavalry is on its way, and you now have Social Security coming in, which means less income, about $30,000, that you don't have to take from your portfolio. Now, if the market continues to go up and we have several back-to-back really good years or a good decade, we could pause Social Security and defer it till later because our assets would have grown and that distribution rate is now going to be smaller. But if we run into a nasty bear market, that's where we can infuse that cash into our portfolio and our retirement plan to preserve our assets. And so what we wanted to do is we wanted to run this through our retirement income model. We refer to this as Income Lab, and this is where we cross compare our income plans and say, hey, are the numbers congruent? Are they consistent? And what does this look like? And the biggest thing here, two key factors. One is, how does our income adjust in years where the market's down? So we talked about having that second budget, and keyword here being temporary. When does Michael need to cut money? Should he need to spend a little less to give that portfolio breathing room until markets recover? And then second, when we look at what we're actually taking out, we need to account for taxes, right? There's a difference between the money that his portfolio is going to need to generate and what we're going to take out and what he's actually able to spend after taxes. Okay, that comes back into that $18,000 figure, which is right in line with what he wanted. And it's also in line with a sustainable distribution rate. Now, the second thing we're going to get into is having a distribution plan. You remember when we looked at Michael's portfolio, if we go here just for a moment and we click on his assets, one thing that we could see from Michael is that he did a really good job having flexibility in his retirement plan. He had taxable assets that were almost $3 million. Now, a lot of that's wrapped up in capital gains, and we'll get to that in just a moment. But being able to have multiple options and flexibility in retirement of where should we pull our first dollar from? Because again, he's going to go from the 32 to 35% tax bracket all the way down to probably the 12% tax bracket. And now we have some wiggle room on figuring out, should we just take everything from the brokerage account and fill up that taxable bucket with capital gains at a much lower rate, or should we start to do some Roth conversions because he's going to be in such a low bracket? So this is where we start to look at income mapping and bracket filling to figure out where and how can we start taking distributions from in the most tax efficient way without paying more than we need to in taxes. The second variable we had to attack for Michael is, how do we balance our portfolio? What does that look like going into retirement? Because again, I had to remind him, you're playing a different game now. Michael, you've won the game in building and accumulating assets. And if you want to continue to stay on that train and play that game, that's fine. Keep going down that route. But if we're now transitioning into retirement, we have to start thinking about, how do we move our assets like tech and the S&P 500? And instead, how do we build that portfolio that now achieves two things? It's total return. It's both income and growth, because you're, again, entering a different phase. And so how do we do that in the most tax efficient way? Because Michael, he's not 65, he's not 70, but his portfolio should resemble something closer to that as he needs more money. Because as he's transitioning from accumulation to distribution, that 100% equity portfolio exposes Michael to what we refer to as sequence of return risk. That's the danger of poor market performance early in retirement, which can drastically and permanently damage his spending capacity for his entire retirement. We don't want that. You see, the volatility in his portfolio, while he was working, he could deal with those swings and those bouts of volatility. But as he gets closer to retirement, he needs to start drawing that income. Again, we don't want to be pulling from that portfolio when it's down 20 or 30%. So we want to smooth out that ride and find the right balance between those growth assets, because it's going to be a long retirement, and then more stable income producing assets to weather that invariable market downturn. And then we also have to make sure to do that in a tax efficient way. And so when we build this for Michael, because again, he has that retirement account flexibility, he has a 401k, a Roth, he has some cash, and he has a brokerage account. What we begin to look at is his overall asset allocation, not from each individual account. And so these accounts begin to look a little wonky in terms of why does this account have 20, 30% stocks and the rest bonds or things like that? Well, the answer is the only other way to get a balanced approach into his retirement is by triggering taxes. And so we want to be able to figure out how can we add some stability and some safety into his portfolio without triggering taxes. And that's one of the ways. Because when we start taking distributions, one of the things that we could do, as we talked about earlier, was starting to take money from those highly appreciated assets and triggering taxes now at a much lower rate. And by doing this, it accomplishes a couple things. It now allows us to, each distribution we take out, we limit more of our volatility and exposure to those single concentrated assets. And number two, it provides us with that retirement distribution income at a much lower tax rate. And the last thing that we talk about, and it dovetails into what we discussed earlier, which is where do we take our first dollar from? Because the 401k, unfortunately for Michael, is not going to be an option. We have the rule of 55, which states that if you retire at 55 or in that year, you can access, if you leave your 401k at your employer, your pre-tax assets before 59 and a half without incurring a penalty. Now, you have 72T distributions and several other mechanisms like accessing Roth contributions. I made a video on that. Feel free to check that out. But for Michael, what we looked about was what does it look like to start taking those distributions from our brokerage account, from our cash. See, we had been working together for a couple of years. And one of the things that we encouraged him was we're now at a point where it makes more sense to start putting money into your brokerage account, your cash. I call this your war chest. That is the account that you're going to take your first distribution from. That's not only safer, but it's also more tax efficient than taking it from anywhere else. And so during his final years of working, we were looking at, rather than putting everything into the 401k, go get your match, Michael. That's great. But everything else, let's start with early retirement in mind, figuring out how to fund those other accounts that are more easily accessible and tax friendly. Because in that first couple years before he hits 59 and a half, really our only options, cash, money market, and his brokerage account. We really don't want him touching his Roth unless he really needs to. And then once he hits 59 and a half, really Pandora's box is open. He has access to everything. And that's where we could begin looking at, should we bracket fill? Should we take more capital gains? Should we do Roth conversions? Or is it better to leave our taxable income as low as possible to qualify for potential Affordable Care Act, health insurance subsidies to have lower premium? So there's a lot of moving pieces here for Michael in his plan, but being able to have that game plan for how do we take that money out. Now that you've seen what $5 million can provide for someone who wants to retire early at 57, you could better understand the importance of having a plan in place. Now, if you find yourself in a similar situation, whether it's $2 million, $5 million, or $10 million and up, the same strategic principles apply. It's not just how much you have. We have to get the money out. It's about having a plan for how to access that money, how to minimize taxes, and most importantly, how to protect against the risks inside your portfolio that could derail your entire plan. If you have questions as you're watching this video, go ahead and click on the link in the description below, and we will send you a personalized Loom video walking you through your portfolio, build you a retirement plan for how you can optimize your retirement income without getting crushed in taxes. Again, so if you have questions, fill out the survey. We'll send you that personalized Loom video. Look forward to seeing you in the next video.